Prasad is now joining us, Managing Director and Co-Head at Kotak Institutional Equities. Sanjeev, good to have you with us here. Thank you very much. Let me just actually start with not a broader market view, but on a specific stock. Not so much about the stock, but your view on the industry, chemicals, and your note on Navin Fluorine, where you're pointing out the downturn in the sector as being a worry. What's the view there? And it's one of the few bombed out kind of sectors. Do you think it'll remain like this, or is there any light at the end of the tunnel?
Yeah, as of now, the sector is facing a lot of headwinds, namely two. One is really a global slowdown, which is resulting in volumes getting impacted. And you also have a temporary problem of very high inventory with the customers. So that affected volumes in 1Q FY24 that could sustain into the second quarter also. The bigger issue as of now seems to be industry profitability. That's gone down significantly, although of late you have started to see some improvement. And what has happened is China has come back into the market very, very aggressively, very aggressive on pricing, that is, which has hit the profitability across companies. We had a double whammy of, somewhat lower volume growth. On top of that, you had really a negative impact on profitability. So yeah, that's what is going on in the shorter term. That could sustain for maybe another 1 to 2 quarters. The long-term fundamentals still look good of the sector. The only other point I would make over here is that, a lot of the stock price correction is more driven by earnings correction. So it's not as the multiples have gone down dramatically in these companies. So the challenge remains that valuations at least were fairly high on a near-term basis. And unless you see a sustained recovery in volumes and profitability both, I suspect the sector will still struggle for some more time.
Okay. By the way, the stock of the moment is Marico. Just pull it up. It's down almost, I think, 3% when I checked. Volumes also picking up. Mangalam was telling us how this quarter's numbers were not too great. In fact, the volume growth is in low single digits. And Sanjeev, good morning. This is Sonia here. I wanted your thoughts on what's happening in the consumption space, because across the board, the narrative is a slowdown in consumption, right? And some of these companies like Marico are speaking about it as well. What do you do with these stocks if you own them?
Well, unfortunately, this consumption slowdown has continued for fairly long. It started somewhere in the middle of November 2022, and it's almost a year now. And the commentary from companies, all on the ground channel checks, talks with dealers, suggests the same thing, that demand is still very, very weak as of now. And especially rural economy seems to be still having some challenges. So the hope is things would improve, going forward as the rural economy in particular starts benefiting from hopefully a decent crop output this time around. Monsoons have eventually turned out to be quite okay, despite all the fears in August of pretty bad monsoon. So hopefully with the elections pending also at the ground level coming up in the next few months, that should revive demand. But having said that, the challenge in the sector still remains that valuations are high, in the sense, if you see again the same point I was making about chemicals, most of the the stocks have sort of languished over here, but earnings have got cut. So in a way, the multiples have still stayed on the higher side. And there's one more medium-term issue which the sector will have to grapple with sooner than later. I think market is completely ignoring this aspect. Is the business models and the structure of market, will start becoming weaker as we go forward. If you see across sectors, any of the consumption space, you're starting to see more competition coming in. And you're seeing markets going from a 2 or 4-player market to, to more like a 4 to a 6-player market. So if that is the situation, then the current high profitability which the sector has enjoyed over the last several years and decades, that could start coming under some amount of pressure. So 2 things to keep in mind. Obviously revival going forward over the next few months. But at the same time, you could possibly start seeing some derating in multiples as the market starts realizing that this disruption is for real and it is here to stay.
All right. Hi, Sanjeev. Good morning. The last time we chatted, you were saying that there are segments of the market that are looking a little bit frothy, a little bit expensive, but there is some comfort on financials and healthcare. At current reckoning as well, would you find more comfort out there? Because the broader markets have had this big party, which now seems to be coming off.
Yeah, I mean, if you look at the market, it's a weird market in the sense, let's say the top 5-7 stocks haven't really participated. So if you look at the Nifty 50 as an example, it is up like 10% in the last 2 years. Whereas obviously the mid cap and the small cap indices have done far better. So that's the whole issue with this market, that the large caps have struggled, especially in the banking space, in IT to some extent, and I would put Reliance also in that same bucket. So about 40% of the Nifty 50 hasn't done anything for the last 2 years now, and some of the stocks have actually not done anything for the last 3 years, come to think of it. Whereas you are seeing this big party, in the mid cap and small cap space. Some of it is, driven by a lot of incremental spending by the government in the investment sector, so some of it justified. But I suspect in many cases, the narrative is far ahead of the fundamentals, and I just hope that that the narrative sustains. Otherwise, probably the stocks are going to struggle. In a sense, either you see a swift correction, which is one way, some sanity comes to this market, or you go through a painful period of time correction, as some of the large caps have done over the last 2 to 3 years now.
Yeah. Actually, add to that point, there was a note that you put out, very, it was I think, dark art of valuations, Sanjeev. That was an interesting one. So, you basically were saying that looking at PEs and historical PEs actually is now serving little purpose. So you got to look at different methods, DCF, to see where valuations are, where stock prices are, what they're discounting.
No, there are two things. One is, the valuation methodologies don't change, to be honest with you. The only thing which changes is in the operating environment in which a sector or a company operated. That may change dramatically, in the future compared to what was the operating environment last 5-10 years. Case in point being, the consumption space I was talking about. We have seen a lot of, potential changes coming up. You will look at the premium motorcycle segment. You have pretty much a one-player market over there. That's going to become a three-player market. When you look at the paint sector, from a 3 or 4-player market, this is going to become a 6-7-player market. It's very unlikely the profitability is going to sustain at those high levels that we have seen in the past. But somewhere the market is making that assumption that not only growth will be fine for the incumbents, I don't know, the market will just expand magically. That's what the market seems to be assuming. And profitability also better when you are going to see more competition. That seems rather, aggressive to make, aggressive assumption to make. So that is one point, that somewhere, the way we have looked at stocks historically, whatever were the right valuation metrics at that point in time, we need to probably looking at the new context for some of these sectors. And the second thing is, the point I was making in the report is start looking at reverse valuation, because they reveal a lot, in terms of what the stock price is discounting. And in many cases, it's really, the kind of assumption that is getting factored in is not going to play out for the next decade. Forget about, playing out the next 1 or 2 years, which is what the market is assuming, those assumptions to play out.
That the other, you guys are sort of titling reports in very interesting ways. That madcap rally, I think that caught on quite a bit over the last many weeks. Just one last question. Again, there was a report you put out asking the question, who's right? And that was basically about, all the selling by promoters and PE, something that, our team here is focused on as well. And all of that getting absorbed by investors. Is there an answer to it, Sanjeev? Because you've looked at it in quite a bit of detail.
Only answer for the market is time. Only time will tell who is right and who is wrong.
But what is...
Sooner than later, keep in mind the fact that there is a lot of promoters selling, but in some cases it's more driven by strategic considerations. So if you leave aside certain conglomerates who have had to sell for whatever reasons, it's not as if there's a lot of promoter sales which are taking place. The selling is more being done by the PE guys, and obviously they have their own considerations apart from the price factor. Obviously, it is a no-brainer that valuations are high, and some of the PE guys would like to take money off the table. But obviously, they are also constrained by time consideration. Like if a fund is coming to a closure for 7-8 years, whatever the time frame may be, they're probably going to sell. So it could both be price as also other considerations.
Okay, all right. We will let you go on that note. Thanks a lot, Sanjeev, for joining in.
Thank you.
And thank you for joining us. That's Kotak Institutional Equities.